Okay, this is Timing Strategies client blog update for September the 5th, Friday. This is communication purposes only for clients. It's not a recommendation to buy or sell. If you have any questions about it, please feel free to give us a call or an email from our website, admin@timingstrategies.com. Also, please feel free to check out our 401k IRA resource management page at our webpage, section. It's really a value-added part of the page designed to help folks that are in their own 401k employer plans or managing their own IRAs or both, to kind of give them a lot more value-added service other than what most plans generally provide. Again, great resource. Please feel free to check that out. That said, let's get to the quick. We were long 20% on the S&P as of the 20th of August. We increased that long position to about 35% in the indices with 15% Dow and NASDAQ, so we're effectively long 35% in the indices. We are also long using the basic materials sector, another 5% there. They trade pretty close to the market, only it's a little closer on the upside, better to the moves on the upside, so effectively we're long 40%. But that's the material sector which makes up 5 of that 40%. We're also short the 30-year government bond. I'm going to use the TLT as a proxy. We're short using the RIDEX inverse government bond portfolio of 5% as of Friday the 5th. And we're also long gold and precious metals and oil. As of the 11th of August, we were long 7.5% using the energy sectors in the RIDEX account, 7.5% as of the 11th of August, and also long precious metals using the GDX as a proxy as of that same time. We're still holding that. And again, with the spiders or the long indices, we are now short. We are short only the IWM or the Russell 2000, 10% against the basket in our long short accounts that is long 40%. Now, we are also with our long only accounts basically long effectively 40% straight. The only thing we don't have in our long only accounts that we do have in our long short accounts is we do not have the short bond position and we do not have the short Russell position. That said, what do I think is happening? What's my estimations? What our systems are telling me? Looking for a retrace back up to take at least a test of this high of the 126 half level, possibly as high as the top end of that range of the 130 price tag again. At that point, depending on what we see, what kind of price action we get, will determine whether we want to hold that long position or if we want to just cut it, go flat, or actually go short up in this range area between 126 half all the way high to 130 half, if we want to cut it and go flat, or we want to go short to opt for a higher long position if we get a trade back down to 1175. Again, we're still looking for 1175. We may not get it, and this market may just take off for the end of the year, bust that high. Ultimately, I'm looking for a trade up to about 133 half, right around there where the S2 level is at, 133 half, all the way to as high as potentially 139 half, right around in that level where we should actually put a S2 or S3 level in. So this is ultimately for the end of the year. I'm looking for a move up into this range that's going to test basically the highs that we put in back in May the 19th. I don't know if it's going to break that high or not, but the test of that high I anticipate to be somewhere between 1335 on the S&P all the way to 1390, and at that point we'll give you an update as to what we're going to do. Beyond that, there's so much going on going into the end of the year, and I don't want to speculate as far as to what's going to happen. We got a lot of problems with the credit markets. There's a lot of garbage going on in Wall Street looking for handouts, bailouts, welfare on your and my dimes. They don't want to pay for their mistakes. They want us to pay for their mistakes. So depending on how that gets worked out will determine really what we really get. Ultimately, I'm going to give you a longer term picture. We're in a bear market. I anticipate that we're going to see a big deep sell-off that ultimately is eventually going to challenge or take out the 2002 low levels on the Dow or the S&P as deep as about 750, 780. That's long term. I got some notes in here, but we're also coming into a cycle right now. 2-year cycle from October to the 2002, 2004, 2006. Here we are, 2008. It's a little bit late, but I still anticipate that cycle to give us a bounce of about 5 to 10%, like I said, up into that 1335 to 1390 level, somewhere in this range. It's probably just going to be, a squelched bounce, and eventually, once that bounce fails, I anticipate it to wipe us back out again, take out those June lows, the July lows, and also ultimately, maybe sooner rather than later, the way the momentum to the downside is coming in, take out the 2004 lows. Those are the critical area for the S&P, the 2004 cycle lows. So if I knew what was going to happen, I'd certainly tell you. I don't have a crystal ball. All I'm trying to do here for folks is give them the best estimation of what I can see from here and play it day by day. So if you have any questions, please feel free to give us a call. We'll be putting out a new client MOC newsletter update. And beyond that, I wish you all a great week.